Hi, this is Alessio, hope you're well. In this video I want to explain to you the number one reason why I use Elliott waves for chart analysis. Now you may recall a while ago I already made a video which you probably saw as to why I use Elliott waves. I explained that Elliott waves have nothing to do with astrology or Nostradamus, but in fact Elliott waves are based on phenomena that occur in nature. Now if you've not seen that video, the good news is I'm going to play for you one more time what I said back then about Elliott waves. But if you have already seen that video, well, this will be a nice refresher for you. But at the end of this video I'm going to add for you some new material, so make sure you watch the end of this video, and I'm going to mention some of the important ways you can use Elliott waves to improve your chart analysis. Alright guys, so first let's dig into the video with what I said back then about Elliott waves, and at the end of this video we'll come back and I'll mention some new important material. Thanks. Some people were saying that all this Elliott wave stuff was Nostradamus, you know, looking into the crystal ball to see the future. And some people were saying, oh, this is astrology or things like that. Honestly, guys, it seems to me that some people do not understand why we apply and use Elliott wave theory. So very quickly, the key behind Elliott wave theory is simply fractals, or fractal geometry. So what are fractals? The physicist Alan Guth says in his book, The Inflationary Universe, he says, a fractal is a geometric figure in which a pattern is repeated ad infinitum on smaller and smaller scales. Actually, I think probably a better definition of a fractal is what's given by James Gleick in his book Chaos. I'm sure you've heard of chaos theory. Well, chaos theory is also called the butterfly effect. And here's the thing, guys. In this book, Chaos, we learn that fractal systems, things which are fractals, exhibit something called self-similarity. In fact, fractals are self-similarity. In other words, fractals are simply things which look roughly the same at different scales, especially on smaller and smaller scales. It's a bit like Russian dolls. You know those Russian dolls, which I think are called matrushkas? When you open one, there's a smaller doll inside. And when you open that one, there's another smaller doll, and so on and so on. So many decades ago, scientists found that certain things in nature, certain systems, exhibit fractal geometry, which means on smaller and smaller scales, they look similar or roughly the same as the bigger part. Okay, I'll give you an example here. Think of the branches of a tree or the leaves of a tree. So when you look at the branches of a tree, notice that they subdivide, the branches subdivide into smaller but similar versions of the bigger part. You see fractals and self-similarity also in blood vessels, in human blood vessels. You see it on the coastlines. Interestingly, the physicist Alan Guth says in his book, The Inflationary Universe, that the multiverse, the system of multiple universes, also exhibits self-similarity or fractals. Okay, let's go back to what we were talking about, fractals. So back about 100 years ago, Ralph Nelson Elliott, he found that even in financial markets, you see fractals. So what Elliott discovered was that in the financial markets, you see 5 waves move in the direction of the larger trend, but 3 waves against. And he found that this pattern repeats itself on smaller and smaller scales, again, in the financial markets. So for example, each wave, as you can see on this chart, each wave subdivides into smaller versions of itself, of the bigger part, on smaller and smaller scales. So you have waves within waves within waves, like Russian dolls. And similar with branches of a tree, as we discussed. So in other words, guys, fractal geometry occurs in nature, as well as in the financial markets. Now you're probably thinking, well, why does this pattern occur in the markets in the first place? Why does this Elliott wave pattern occur in the financial markets? Well, here's the thing, guys. According to Bob Prechter and his phenomenal work in the socioeconomic theory of finance, human behavior and mass psychology creates waves of social mood, which leaves an imprint, leaves a signature on the markets. So when you think about it, human beings, we're emotional creatures. We're also irrational creatures. And what investors and traders do in the markets, and this could be any market, could be stock markets, Bitcoin, gold, whatever. What people do in the markets when they're buying and selling, in other words, the waves of social mood among investors and traders, from anxiety, fear, to euphoria and greed, these waves of social mood, they leave their signature. They leave their imprint, their trace in the markets. And interestingly, it follows a fractal pattern. Again, remember what we discussed about what fractals are. And that is why we see this fractal pattern, this Elliott wave pattern in the markets, as Ralph Nelson Elliott discovered. By the way, R.N. Elliott was able to use his Elliott wave theory to predict and forecast a minimum 80-year-long bull market back from the 1940s. So back in the 1940s, Elliott said, we're going to be in a bull market for at least 80 years. At the time, people thought he was crazy. People were saying to Elliott, how can he be bullish on the market when we have a war, the Second World War in our hands? But Elliott was able to use his wave patterns to forecast this minimum 80-year-long bull market back from the 1940s, which of course he was correct about. By the way, guys, one of the key reasons why I love and I use Elliott wave theory is because it's the only method of analysis out there that provides context. No other method of analysis can give us that. In fact, Bob Proctor agreed with me on this point, that it gives you context like a big picture or map of the market. Of course, we're talking about probabilities here, but that's all you need to give you an idea of where you potentially are in the big picture and look for turning points. A lot of people miss turning points because they're looking at the markets from a linear perspective as opposed to a non-linear, chaotic perspective as we find in fractal patterns and also in Elliott wave theory. Alright guys, so I'm hoping in this brief introduction I managed to persuade you that Elliott wave theory is not some hocus pocus, crystal ball magic or voodoo, as some people say, you know, like Nostradamus or astrology. No, those people have no idea what they're talking about. As I mentioned, Elliott wave theory is simply using the fractal geometry that exists in nature. By the way, this subject of fractals and social mood, which is essentially what drives the markets, reminds me of the work of the French philosopher Michel Foucault. I'm actually reading a series of works on power by Michel Foucault in this book. And Michel Foucault's ideas on power are really interesting and fascinating. And what Foucault says is that power does not necessarily work top down like what a lot of people believe. No, actually, it can work also bottom up. In fact, as Michel Foucault famously says, power is everywhere. So with the financial markets, a lot of people think that the reason why markets move in one direction or another is because there has to be some omnipotent agency like the Federal Reserve or the government to push the market in one direction or another. In other words, they think the Federal Reserve drives the market. Actually, that is not correct. As Bob Proctor has argued in his book, The Socioeconomic Theory of Finance, it is not the Federal Reserve that drives the market. It's the opposite. It's the other way around. It is the market that drives the Federal Reserve's decisions. Again, it is human behavior, emotions, and mass psychology that creates waves of social mood that ultimately drives the markets. More on this, by the way, in a separate video. But that also is what Michel Foucault argues on power. Power is a productive force that occurs organically within society and systems. Alright guys, welcome back. So thank you very much for watching that video. So what I'm going to do now in this section of the video is just explain very briefly some of the ways in which you can use Elliott waves to improve your chart analysis. So as I mentioned before, one of the key benefits of Elliott wave theory is that it can help you identify what is coming around the corner. In other words, because it gives you context, in fact, it's the only method of analysis that gives you an idea where you are in the big picture, like a map. So one of the main strengths in Elliott wave theory is you have an idea, the turning points in the markets. You see, a lot of people who just follow trends, people who just simply follow trends and movements in the price, they often miss or ignore what is coming around the corner, the key turning points, the key inflection points in the markets. So what often happens is when price is rallying higher, people just assume the trend will just continue forever. And similarly, when price is going down, declining, people assume that the trend to the downside will just continue forever, eternally. So the fundamentally great thing about Elliott wave theory is that if you can identify with a high probability as to where you are in the wave count, you can also identify with a high degree of probability as to what's going to likely happen next. I'll give you an example. If your analysis is telling you that you're at the final stage of wave 3. So for example, if you've done your chart analysis, and let's say you believe that you're in the wave 5 of wave 3, the final phase of wave 3, then you can prepare yourself for the wave 4 correction. Now here's something you need to know about wave 4. Wave 4 corrections are not necessarily clean and precise like this. In fact, wave 4 corrections can be very messy, unpredictable, and very choppy in their movements. So if you believe, based on your analysis, that you're coming to the end of wave 3, what's called the wave 5 of wave 3, then you should prepare yourself for wave 4 correction, okay? And again, wave 4 corrections, because they're messy and unpredictable and choppy, then that allows you to prepare for risk. Not just risk in the markets, but also risk mentally, because often wave 4 corrections can be very frustrating emotionally and mentally for traders and investors. So therefore, being prepared for a potential wave 4 correction can really help you as to the turning point in the market. And that also means a trader could potentially prepare himself for a wave 4 correction by taking profits. For example, he could take partial profits or maybe establish a hedge to protect against a downside risk. Now here's another good use of Elliott wave theory. We know that corrections are formed of 3 waves, what's called ABC corrections. If you've done your analysis and your research and you believe that you're coming to the end of the wave C of the correction, for example, wave 2 corrections or wave 4 corrections. So let's say you've had a major big move up, and let's say you've had a three-wave correction, in other words, an ABC correction. Let's say as an example, you're coming to the end of the C wave of wave 2. Then you ought to prepare yourself for a potential wave 3. And that is important because wave 3 is typically the strongest and most dynamic part of a trend. It's usually the longest wave, but it doesn't have to be the longest wave. And by the way, guys, that's a common misconception. A lot of people think that wave 3 is always the longest wave in a trend. Not true. Sometimes the wave 5 can be the longest wave. The rules of Elliott wave theory simply say that wave 3 can never be the shortest impulse wave. So out of the three waves, waves 1, 3, and 5, wave 3 can never be the shortest wave. It is typically the longest, but it doesn't have to be. And here's another important way you can use Elliott wave theory. We've already said that wave 3 is typically the strongest and most dynamic part of a wave. But did you know that within wave 3, the strongest, most powerful part of that wave 3 is the wave 3 of the wave 3. This is what's often called the wave 3 core. By the way, if you're confused by this terminology, all that means is because wave 3 of a trend is subdivided into 5 waves, the wave 3 within the wave 3 is the strongest and most powerful part of the wave 3. So what that means for traders is that what they could do is wait until the beginning of that wave 3 of the wave 3 before they establish a position. And finally, we know that wave 5 is the last final part of a trend, what's often called the last gasp stage, the last climax in the market or in the trend. So therefore, if based on your analysis, you believe you're in the final wave, the wave 5 of the wave 5, that means you should prepare yourself for a potential reversal, a key inflection point. As an example, if you believe you're coming to the wave 5 of the wave 5, the last portion, the last section of a trend to the upside, then that means we're getting very close to a potential top in the market. Then a trader in that situation could decide to take more profits and perhaps even protect themselves against some kind of downside risk in case the market then breaks support and then starts a reversal in the pattern. Now, by the way, you should always combine other technical methods too. For example, a break of support or maybe some kind of a topping pattern or something like that. So you can combine other technical methods with Elliott waves to increase the probability. All right, guys, I'm hoping this video has helped you in some way. Thank you very much for watching, and I look forward to seeing you in the next video update. Bye for now.